Welcome to Alu Speaks with Alu Patience. Today we'll be discussing on the topic form of business. This is the third topic in corporate finance. If you have not watched our previous topic, I would advise you to do so. However, do not worry. We'll be breaking today's teaching down to be as simple as ABC. At the end of today's class, we would understand the different forms of business. We will understand their features, their advantages and disadvantages. Then we will look closely into the corporate form of business and discuss how it relates with separation of ownership and its impact, and how it leads to conflict of interest between the corporate objective and the managerial objective. Like I said, we will be discussing different forms of business as it relates to their structure, to their business structure. Please note that we are discussing the different forms of business as it relates to corporate finance. So we are not going overboard in this discussion. We will be discussing the three most common forms of business. That is the sole proprietorship, the partnership, and the corporation. Choosing a business structure, choosing a form of business is usually one of the first steps to consider when starting a business. And as the business grows, we may move from one form of one structure to another in order to accommodate our vision for the business. Now, let's start with sole proprietorship. Sole proprietorship is a business owned by one person. It is an informal form of business. The reason why we call it an informal form of business is because you don't necessarily need to register before you start it. So that's why we say it's an informal form of a business. This is the most common type of business because there are more sole proprietors in Nigeria than other forms of business. Let me dare say even in the whole world. Like I said, it is an informal form of business. You don't need to register or have a license or any document for you to start this type of business. However, as the business grows, you may need a name for your business so that your business can be recognized, and you may also need to pay tax. And in such a situation, then you will be required to register your business name with CAC. That is Corporate Affairs Commission, and also get a tax identification number. However, let's not digress too far. Let us discuss some of the importance or advantages of a sole proprietorship. It is easy to start. Like I said, because it's an informal form of a business, you don't need documentation. It is least regulated. There is nothing like, you must have 10,000 naira before you start. You must have 100,000 naira before you start. It's the least regulated. Nobody is going to tell you, you cannot start from your house. You must start in this particular district, or you must do it in this particular standard. No, it does not have such things. That's another beautiful thing about it. And since it is a sole proprietorship form of business, that is a business that is owned by one person, the owner gets to keep all his profits. All the profit made in the business belongs to the owner. He doesn't need to share. And because it is just a one-man business, it has a fast decision-making process. He does not have to consider the views and opinions of other people before he makes decisions affecting his business. And like I said, there is no cap that you must start with this particular amount of capital, which means it is cheap to start. It is cheap to start, relatively cheaper than any other form of business. And it is easy to pay taxes on such business. Such a business. It is not complicated. What I mean, other forms of business, you may need to prepare a balance sheet, financial statement, and whatnot. But in the sole proprietorship, all you need is your income statement, and you can actually file your tax yourself. It's easy. The tax process is not complicated. And apart from that, your business is taxed only once. You pay personal income tax, the same tax that they will charge charge somebody who is earning a salary is the same tax they will charge you as a sole proprietor. Some of the bottlenecks facing the sole proprietorship is that your source of capital is limited to your personal wealth. That is, your source where you can raise money is limited to your personal wealth, how much you can save, how much you can borrow from friends and families. You understand? How much is in your savings. What I'm trying to say here is that the equity capital is limited because you have less financing options to generate funds for your business. Another thing is that the life of the company is limited to the life of the owner. What I'm trying to say is that it is not a going concern. If the owner of the business dies, the business dies with him. It is not a going concern. We do not see that future, that business existing into the unforeseeable future. Going concern simply means when a business, you can foresee a business living on into the unforeseeable future. By going concern, we mean we do not see that business dying anytime soon. We expect it to continue in perpetuity if possible. Also, the liabilities of a sole proprietor is unlimited. That is, there is no asset protection. That is, if the sole proprietor incur debt, he may have to pay with his own personal property. That is, the sole proprietor can suffer the liabilities of his business. Any liability his business incurs in the course of doing that business, he may suffer for it personally. And this makes a sole proprietorship business a bit risky. That is because in the eyes of the law, the sole proprietor and his business is the same. There is no difference between the sole proprietor and his business. So any debt he incurs in the course of doing his business, he would pay for it. You may ask, what can a sole proprietor do in order to protect his personal properties from liability? The sole proprietor can take a liability insurance cover over his business. If you are still here, please like, subscribe, and follow. And do not forget to click on the notification button so that you do not miss out on future amazing topics. The partnership business, this is another form of business. The partnership business is so much like the sole proprietorship business, but the main difference between the partnership business and the sole proprietorship business is that the partnership business, the owners are more than one. We can have two or more people in such a partnership. Partnership business simply means when two or more people come together in order to do or carry out a business. It is usually an informal form of business like the sole proprietorship, and also does not necessarily need documentation. However, if you want such partnership to last, it is recommended you line up your goals and views for the business so as to be on the same page, so to speak. What I'm saying here is that you should have a partnership agreement guiding you. Like I said, the partnership business is very much like the sole proprietorship business, because these liabilities are also unlimited. That is, partners are liable for the debt that is made in the partnership. Even if one or two of the partners claim they are not aware of when that debt was incurred, is immaterial. So long as that debt was incurred by the partnership business, they are all equally liable. This type of partnership, where all partners are equally liable for the debts and liability of the business, is called a general partnership. that all members, all owners in this partnership are liable for the debts and liabilities of the partnership. However, we have another type of partnership. This is called the limited partnership. This is called the limited partnership because at least one of the members has a liability that is limited to his contribution into the what? Partnership. This is a more formal type of partnership, unlike the general partnership that does not necessarily need documentation. This type of partnership has to be properly documented. You note when we say a partnership is when two or more people come together. When we say persons or people, we do not actually mean an actual person. It can also be a corporation. Let me give an example. Mr. Ejike and MTN Nigeria Limited can decide to partner in a new business to produce Wi-Fi devices. In this kind of situation, you can find that Mr. Ejike's liability is unlimited, while MTN Nigeria Limited is already a limited liability company before joining the partnership. Therefore, MTN's liability is what? Limited to its contribution into that what? Partnership. We should note that a limited partner does not actually partake in the management of the business. He leaves that to the unlimited partner. In this situation, Mr. Ejike, who obviously has more to lose if the business fails. Some of the beautiful things about partnership is that we have more owners. It's more than one person, and we all know two heads are better than one, since we are able to make better decisions, since we are swapping expertise, we are swapping knowledge on how the business can move forward. Another beautiful thing about partnership is that the partnership form of business is that more capital is available. So we now have more people who would contribute more funds, which is basically the main reason why people go into partnership in the first place, so as to increase their capital acquisition prowess. Instead of me depending on my personal wealth, I will join business with Mr. Ejike and Mr. Adamson. We all join together, contribute our personal wealth together to raise a larger capital. And like the sole proprietorship, it is relatively easier to start, and income is taxed once. That is personal income tax based on his percentage of the profit in the business. Also, like the sole proprietorship, the partnership form of business is not a going concern, which means if one of the partner dies or one of the partner pulls out of that partnership business has ended, except they reformat a new partnership. However, this is not the case in a limited partnership. In a limited partnership, even if one partner goes off, the partnership still remains intact. And another beautiful thing about the partnership business, especially in the case of the limited liability partner, is that such a partner can transfer his shares. In our example, AGK and MTN Nigeria Limited, MTN Nigeria Limited can decide, okay, I am no longer interested in this partnership. I want to sell my shares to Mr. Jude. However, please let's note that the partner with unlimited liabilities cannot transfer or sell his shares. This is only applicable for the limited partner. I know I said two heads are better than one when it comes to decision making. However, it also makes decision making process quite difficult because different partners with different opinion on how to move the business forward. The liabilities of of the partnership is unlimited. That is, if the partnership suffers any debt or liability, the partners will pay for it with their personal wealth, except such a partner is a limited partner. The partnership business can always get an insurance cover to cover a liability insurance cover to cover any liability they may incur in the course of the partnership. Another disadvantage is that it is not a going concern. That is, the death of one partner can lead to the end of the partnership. And also the profit sharing, in the sole proprietor, he takes all his profit. But in the partnership business, the profit sharing ratio is more complicated because some of the partners, they may be more hands-on in the business than others, and some may have contributed more capital than others. So all this is going to complicate the profit sharing ratio. Also, like the sole proprietorship, it doesn't have so many capital financing options. The financing options is limited to the personal wealth of each of the partners involved. Now the corporation. The corporation, unlike the sole proprietorship and the partnership, must be a formal form of business. By formal here, we mean proper documentation is required to establish this type of business. And this business is a legal entity. By legal entity, I mean that such a business enjoys the legal power of a natural person. That is, the business, it has a name. It can buy and sell properties in its own name. It can sue and be sued. And it can also enter into any contract with any person or corporation. Oh, from this, we can already see it's already showing signs to be a complicated form of business to start because of its legal requirements and its legal standing. And obviously, this type of business will require large capital base. Unlike the sole proprietorship and the partnership type of business, the business corporation has something called separation of ownership. The owners are different from the management of the business. That is, the people who run the day-to-day affairs of the business is different from the owners. The owners have to employ top managers to administer or manage that business on their behalf, and this is called what? Separation of ownership from what? From the business. You would notice that right now I am not using the word owners, I'm using the word shareholders. In corporations, we have shareholders. The owners are known as shareholders. And why is this? This is because ownership is broken down into standardized units, and these units are called what? Shares. And each share represents equal unit of what? Ownership. Each owner can own any numbers of shares according to his or her financial capacity. Therefore, there is no limit to the numbers of owners in a corporation. And because there is no limit to the numbers of owners in a corporation, all the owners cannot obviously manage that corporation, cannot obviously oversee the top managers they employed. So what do? They come together and elect a board of what? Directors to control, to direct, and create policies and goals on behalf of the entire owners. And these policies and goals and direction created by the board of director is to what? Is to help guide the management who carry out the day-to-day activities of the corporation. Like I said before, two parties are involved in a corporation, the shareholders and the management. So the shareholders are more like the principal of the business, while the management are more like the agents of the business. In our subsequent topic, we will dwell more on this principal and agency relationship. Like I was saying, the owners are what? They are shareholders. They are holders of equity contracts, because each unit of share is an equity contract. So shareholders are what? They are holders of a set of what? Equity what? Contracts. Now let's discuss the advantages of a corporation. Ownership is represented by shares of stock. Ownership is easily identifiable, easily measured by what? By shares of stock, units of what? Of shares. And also these shares, they are stocks, they are easily transferable. That is, a shareholder can decide to sell or transfer his shares. And this will not affect the going concern of the business. A corporation is seen as what? A going concern. We expect a corporation to live into the unforeseeable future. One of the most beautiful thing about a corporation is that their liabilities, the liabilities of the shareholders, is limited to the amount they contributed into the business. That is, their liability is limited to the shares they contributed into the business. Should the business fall into debt, all they get to lose is the amount they contributed into the business, if at all. And because a corporation can easily acquire shares in the financial market, it is easy for them to raise capital through shares and bonds in the what? In the financial market. However, the corporation is a more complicated form of business because it requires many formal documents to start. Another setback is that the corporate business suffers from double taxation, since the profit made from the business is taxed company income tax, and the dividends shared to shareholders are also still taxed personal income tax. So it suffers from double taxation. The separation of ownership from management in the corporate form of business also leads to agency problems. We shall discuss that in our subsequent topic. We said that the corporate form of business requires proper documentation. So what are these documents? They are basically the bylaws and article of incorporation. The bylaws, it contains rules and regulations that guides the corporation on how the corporation is run. While the article of incorporation, it describes what the corporation is all about. That is, it includes information like the name of the corporation, the purpose of the business, the intended life span of the business, the numbers of shares of stock the corporation is authorized to issue, the nature of the shareholders' right, and the numbers of members in the board of directors. These are some of the few information you can get in the article of association.